The number of Americans on welfare has now exceeded 70 million.
If you lose your job and you run through every last penny that the state you live in is going to pay you in terms of unemployment benefits, you have no choice but to theoretically go straight into the full social safety net, go on welfare, go on food stamps. The bankruptcy cycle is more a reflection of the reality of the labor market in the United States. We've seen a higher number of corporate bankruptcies outside of the heat of the pandemic.
What are the major risks that could derail this momentum in the risk assets that we've seen?
I think the major risk, again, is
Danielle DiMartino Booth returns to the show. She is the CEO of QI Research. We'll be going over her updated macro outlook. Welcome back, Danielle. Let me play for you this clip from Jamie Dimon, JP Morgan chief, and then let's just get your reaction, and then we'll start there. Take a listen.
And we have this war now, almost 1 million casualties in Ukraine. The Ukrainians say that 20,000 children have been kidnapped and sent to Russia. It's quite clear that Russia, Iran, and North Korea are acting in cahoots. That China isn't kind of part of that, but they're aiding and abetting Russia. China and Russia have spoken about dismantling the world order set up by America and the Allies after World War II, which have been quite successful in keeping peace. They want to do it differently, and that's their right. I don't think it's a good idea for the Western world. And of course, the terrorist acts in Israel is being attacked, basically on 3 or 4 sides. This is tough stuff.
So the world is getting ugly. He listed a bunch of geopolitical problems. I'll let you respond to that. Are geopolitical problems, especially the ones he listed in particular, are they top of mind for investors right now?
I think it's curious that even though he describes a widening array of geopolitical tensions around the world, that investors, after many years of being numb to this kind of analysis, to these kinds of risks, remain kind of like, that's over there. It's not going to affect us. And that really has been what we've seen in a higher and higher concentration of U.S. market capitalization as a percentage of global stock market capitalization. I think American investors will only believe it when they see it. And that's kind of the attitude. And as far as they're concerned, oil prices seem to be pretty well contained where they are. And none of the disruption around the world has really affected the U.S. stock market. So away we go.
We'll come back to that in just a minute. We haven't talked about the Fed cut yet, so let's segue into that. So you and I spoke before the Fed made a 50 basis point cut. What was your initial reaction to that cut?
Well, my initial reaction was that it was a pretty logical step that they took. There were 3 things that Chair Powell mentioned for justification for going 50 instead of 25 when he was at the podium after the FOMC meeting. He mentioned the fact that payroll revisions are material. Downward revisions. Of course, we originally had 2.4 million jobs created in the private sector announced when the BLS first announced on non-farm payroll Fridays, those job gains. And we find out that in the year through March 31 of 2024, it wasn't actually 2.4 million jobs that the private sector created in the United States, but rather 1.4 million jobs that were created. The second thing Chair Powell mentioned was July and August being fairly weak payroll reports. They've even got the potential, given what some analysts see going forward and the trajectory of the downward estimates, to potentially be negative when the ink dries on those reports after revisions. And he mentioned the Beige Book. And I think the Beige Book is the one thing that he cited that the markets did not pay close enough attention to. When you have 12 out of 12 Federal Reserve districts across the nation reporting that spending is declining, that's going to get the attention of the academics and the PhDs who populate the Fed. It's going to get the attention of the Federal Reserve staff because it's not necessarily a prerequisite to going into recession. We've seen 3 modern day recessions, 83, 91, 2001, that actually had consumption never decline, much less decline across the country. So I think that those were the reasons that they felt that they had to play catch up and make up for the July rate cut that they did not pursue.
He used the words strong economy several times, and he also used the words slowing labor market. I think the words slowing was used by him during the press conference. Is that a contradiction of ideas here, that the economy is doing fine, but the labor market is slowing down?
Well, in the sense that U.S. GDP is almost 70% the US consumer, and we've got a slowing labor market. We have part-time employment in the United States has already recaptured the highs that it saw at the peak of the Great Recession, meaning there are a lot more people than there were a year ago, let's say, not making full-time incomes, but rather making part-time incomes or working 2 and 3 jobs to make ends meet. And that's definitely a sign of labor market cooling. But we've also had nearly 400,000 individuals who are 55 and older rejoin the workforce in August and September. And, why are they coming back into the workforce unless it's possibly to help their kids who used to have a full-time job and now they're working a part-time gig as an Uber driver?
He said job gains have slowed. Those were his words. This was before last Friday's jobs report that showed 254,000 jobs added. I posted several videos about this already. The comments were pretty consistent. These numbers are fake. We're going to get downward revisions. Nobody trusts the data anymore, Danielle. What can we trust? Give us some real-time indicators of what the job market is actually doing. Yeah.
Let me play devil's advocate here. And instead of being an advertisement for Zero Hedge and it's only government jobs and it's all a conspiracy and it's all fake.
Sure.
Well, if you look under the hood of what the numbers actually were, you saw that there were jobs created. There were more than 50% of private sector job creation was in healthcare and in education. If you're going to get sick, you're going to the doctor. If you're of school age, you're going to school. And the fact that we've seen more than 50% of job creation every single month in 2024 through September, and we've seen an acceleration of job growth compared to the private sector in those two, what we call recession-proof sectors, then, by peeling back the onion 1 or 2 layers, yes, we're still creating jobs in the United States of America. Yes, they're going to be revised downward going forward, but these are recession-proof industries that have no reflection upon this state of the cyclical U.S. economy and whether or not it's in recession. And I think that these are the details that we have to pay attention to. The fact that we saw a 14-year low in the work week, 34.2 hours. That means that companies may be holding on to their employees for longer than they otherwise would in a different type of a cycle after they didn't maybe have to fight so hard to bring those employees onto their payrolls, but they've cut their hours to a 14-year low. And I'm sorry, but hours worked, times whatever you're making per hour, that's income. So income is still being destroyed given the shrinkage that we've seen in the US work week.
Are you liking the video so far? Well, before we continue, let me tell you about an innovative way to create videos, which I can tell you from personal experience can be challenging and time-consuming. Today's sponsor, InVideo AI, makes the process incredibly simple. Whether you are a content creator, marketer, or business owner, InVideo AI transforms your ideas into polished, professional quality videos in just minutes. It's the world's most used AI video creator with over 10 million users across 150 plus countries. All you need to do is type out a text prompt. From there, you can get creative and fine-tuned ideas for your videos using just text commands. It's like having your own video editor on standby. And the best part, you can clone your voice and make it narrate the videos in your own voice in any language. It does the job of more than 10 tools packed into one and costs just $20 a month to start with. Scan the QR code on the screen here or use my code linked down below to get 2 times the video generation credits in your first month. I've read, and correct me if I'm wrong here, but I've read that a lot of the full-time, a lot of the part-time jobs before are now currently classified as full-time. Can you comment on this? Is that true?
You know what? That comes out of left field. I actually have not heard that. I don't know how you would reclassify a part-time job as a full-time job. That's maybe I need to get out more, or I've just come back from Asia for 2 weeks. That's not one I've heard.
Well, the internet says all sorts of things, so let's move on from that one. Okay, anything in the jobs report that was a little bit strange to you? Now, Larry Kudlow had a sit down with Donald Trump last Friday after the report came out. Immigration was a subject they touched on. Foreign workers. If you flip over to my screen now, one of the remarks that Donald Trump made in a sit down with Larry Kudlow is that foreign workers contributed to a large percentage, well, not a large percentage, but a reasonably sized percentage of the jobs gained, probably probably more so than some domestic workers. Now, is this something you looked at?
This has become a real political football, and being that we're less than a month away from the election, the only thing that I can say is that what I'm seeing and hearing on the ground is that a lot of the construction work has begun to go away. A lot of projects have been completed,
Yeah.
and there may be millions more immigrants in the United States than there were several years ago. But they're not necessarily taking jobs right now, at least in the construction sector. And I will say separately that there are a lot of jobs that Americans really don't want to take. But you no longer have these strange, announcements when you check into a hotel. You're going to have to make your own bed, or you're going to have to come get your own towels. It's clear that a lot of the lowest paying positions that we could not fill certainly have been filled, and you could fill that blank in with immigration. But again, that's not where the majority of the jobs are being created right now. A majority of the jobs right now are being created in education and in healthcare.
If we look ahead now, Danielle, you were doing some research. You told me offline you were doing some research on the bankruptcy cycle and the progress we've made there. Tell us about the research that you've done and how that could impact the labor market.
Well, I think the bankruptcy cycle is more a reflection of the reality of the labor market in the United States. We've seen a higher number of corporate bankruptcies outside of the heat of the pandemic than we've seen, since 2010 or so. And if you think about the process of a corporate bankruptcy, if a company is going to be going into restructuring or potential Chapter 7 liquidation, then the next step down in the cycle is that the employee who no longer has their job is affected. And what we indeed have demonstrated with our research, Epic came out with September household bankruptcies just a few days ago. A year ago, we were seeing household bankruptcies rise by 14% year over year. Now we're seeing household bankruptcies rise by 22% year over year. A lot of the biggest banks are going to be reporting their earnings. I fully expect for them to echo what Ally Financial said in terms of the unexpectedly higher losses that they're taking on automobile loans, repossessions going up. I think we'll be hearing from banks that their credit card charge-offs continue to increase as well.
Well, this discussion we're having impacts the rate at which the Fed is likely to cut going forward. Take a look at my screen here. The CME Fed Watch tool is projecting an nearly 80% chance of only a 25 basis point cut. This probability jumped up significantly following last Friday's jobs reports. And after the jobs report was released as well, the probability of a 350 to 400 basis points Fed funds rate by next June to July has increased as well. Previously, it was down to 275, even 250. So the markets are a little bit less aggressive in pricing in rate cuts. Do you agree with this change?
I think that the data that we see on a going forward basis is going to help us determine whether or not market pricing is right or wrong. Market pricing just in the year 2024 has really swung the full pendulum. We came in saying there were going to be 7 rate cuts in 2024, and then we became much less aggressive in our outlook. And now we're saying that the economy is so strong and so good that we can start to price out where the Fed is going to stop cutting rates next year. I think that it's a highly premature discussion to be having at this juncture, given the fact that we've had 17 months in a row of what we call a rising exhaustion rate. That's the number of Americans who had been continuing jobless claimants, exhausting, running through, drying up their unemployment benefits and being thrown back into possibly just going onto the welfare rolls, or again, having to get a part-time job in the gig economy. We've never seen 17 months of a rising exhaustion rate outside of recession. So I think it's highly premature to be discussing where we're going to be, where the economy is going to be by the time the summer of 2025 rolls around. And by the way, I think Chair Powell would probably agree with me.
By the way, I don't know if we've ever commented on this, but this, according to Pew Research, is federal spending on food stamps having grown substantially in the past couple of years. Now, we know a large part of this was due to COVID, but I was just reading the other day, the number of Americans on welfare has now exceeded 70 million. Now that's twice Yeah, that's more than twice the population of Canada.
David, you just spoke exactly to what I was mentioning, which is the exhaustion rate. If you lose your job and you run through every last penny that the state you live in is going to pay you in terms of unemployment benefits, if you cannot get a part-time job, if you can't become part of the gig working economy, you have no choice but to theoretically go straight into the full social safety net, go on welfare, go on food stamps.
What is the solution to, I guess, this problem, if you want to call it a problem? I mean, it is a problem that we have a growing number of Americans living on food stamps. Is there anything that the government needs to do, or is there anything that the private sector can do?
Well, I think it does come down to the private sector, David, and I think that that's what's missing right now from this equation. And that is a private sector that is fairly confident that fiscal spending is not going to get in the way of the natural cycles, business cycles that economies run through as a factor of time. And we're continuing to run wartime fiscal spending right now. And I think it has become to the point of crowding out the private sector. So I think the private sector has a larger role to play if we are to double down instead on fiscal spending after the election comes and goes and just says, well, we need more of the fiscal spending that we had in the aftermath of the pandemic first hitting. We need to bring back universal basic income and modern monetary theory. You know what? The private sector is never going to step up to the plate in such circumstances because people aren't going to be making enough money to be able to afford their products and services if they're living on welfare.
Speaking of fiscal spending, this came in from the Congressional Budget Office just yesterday. They published their monthly September updates to their outlook. Total outlays are up by 10% in fiscal year 2024. Outlays in fiscal year were 6.8 trillion, the CBO estimates. And importantly, they updated their deficit change. So prior to their update yesterday, they were projecting a preliminary fiscal year deficit of 1.8 trillion. The change is now greater by the order of 139 billion dollars. A lot of it is just accounting, I think, but the fact remains that the deficit is widening, and per the projection, over the next 10 years, the deficit will continue to widen by orders of magnitude. What does this mean for, I guess, not only the economy but also inflation?
Well, I'm not, the inflation question's a little bit trickier to answer. What I can say is that if we're projecting out of our forecast going forward, future Fed rate cuts, that's certainly going to prop up the interest expense that the country has to continue to pay on an ongoing basis. The more we spend on interest expense, the less we have to spend on other types of fiscal spending initiatives. As far as inflation is concerned, I have really yet to see any proof that pork barrel spending, that building out chip factories in the face of one company, say, taking $20 billion in fiscal spending, but at the same time firing 20,000 employees. I have yet to see where that's additive necessarily to aggregate economic output. I think fiscal spending has to be designed properly. Again, when you think of what happened during the New Deal era, which was largely a private-public partnership, those are the types of infrastructure spending in the United States. We still live in a country where the infrastructure is crumbling, but don't just throw money at the problem. Don't have ESG and DEI strictures attached onto this type of spending. Bring the private sector in, bring workers in to these types of fiscal spending initiatives, and maybe you're going to see the needle move on economic output in a better way.
This brings me to my next point. This is from Crescat Capital. The percentage of non-growth fiscal spending as a percentage of GDP has increased. Now, this is just, this is categorized as spending on interest payments, Social Security, and so on. What's your interpretation of this trend here?
It makes perfect sense to me. It makes perfect sense to me, given what you said earlier about more and more Americans being on food stamps. It makes perfect sense given the demography of the United States and the aging of Americans, and the fact that there's going to be more spent on public retirement programs going forward, on Medicare going forward, again, and as we said, on interest expense going forward. But does that generate economic growth? And the answer is increasingly no.
Yeah, does it ultimately really matter? I mean, what really drives economic growth? Is it private sector spending or government spending? I mean, the government spending it on non-productive purposes. Does the market care is my question.
The market should care. Because if you listen to the beginning of this earnings season, some of the companies out of the gate had been reporting that they're doing what they can to cut costs. That's code word for saying cut employees in order to shore up their bottom line, their profit, but that they're missing on their revenues. Because in the case of PepsiCo, people can't afford to buy name brand of Tostitos, so they're trading down. That doesn't help. The private sector growing, the private sector creating jobs, that is what we consider to be exit velocity, sustainable economic growth that builds upon itself.
Let's flip over to one more chart I'd like to show you. I know this is slightly out of context, but this is from the FDIC. And according to their May 2029, 2024 quarterly banking profile for the first quarter of 2024, the unrealized losses sustained by the banking sector into the first quarter of 2024 over the last couple of years actually has been greater than in 2008. Yet no banking crisis on the same scale yet. What do you make of this trend?
Well, what I make of that, David, is that it's much more difficult than it was in 2008, 2009 for the FDIC to broker marriages and mergers between two banks. It's very difficult to get Bank A to buy Bank B when, in order to do so, they've got to take those losses on as a result. And there's only so much money in the public purse. Hopefully, there's only so much money in the public purse for the taxpayer to avoid those losses by the same token. So, to the extent that the Fed is going to begin lowering interest rates, then the losses that you're staring at there will be mitigated as a factor of time, but very slowly, given what markets are anticipating right now. And by the way, at the cost of interest income that many retirees have grown to enjoy. Every 50 basis points of a decline in the Fed funds rate takes about $67 billion out of the hands of retirees and savers. So there is no such thing as a free lunch. And there won't be in this case. But right now, we're talking about the mechanics of the FDIC brokering mergers between banks when they're sitting on this level of losses just in their securities portfolios. We haven't even begun to talk about what the unrealized losses are in their commercial real estate loan portfolios.
Yeah, that leads me to, well, one of my next points. So take a look at this next chart on this page. Quarterly change in loan balances. Again, this document is 2 quarters old by now, but the trend is still in place. I think the next chart shows a change in loan balances on a quarterly and annual basis. The industry reported a decline in total loans of $34.8 billion with 0.3%. Most of the decline was from the largest banks. Quarterly decline was primarily caused by a seasonal decline in credit card loans, as well as a decline in auto loans. You and I were just talking about the rise in delinquencies in the credit card payments, defaults in auto loans, so on and so forth. So are we going to see a more of a liquidity crunch now that the banks have sustained a higher unrealized loss portfolio on their books? The loans, the number of loans given apparently has been trending down, and people have been more delinquent on their loans and their credit cards. So, what does this mean for liquidity?
It means that liquidity is going to continue to dry up. And we've also seen since that report in week to week data releases from the Federal Reserve that go through banks' loan books that the commercial and industrial lending has also come to really a standstill outside of banks lending into the private credit sector. That's one area where we have seen loan growth. You are absolutely correct. It's been several years that banks have been shrinking the size of their auto loan books. There was a lag effect because a lot of banks were not accounting for buy now, pay later. So banks actually pulled back, ratcheted back on shrinking their credit card loan books to later than they normally would have in any other prior down cycle. But boy, they've got the message at this point because they're continuing to see charge-offs rise in their credit card loan books. And this is a classic. Nobody wants to call it that. Happy days are here. The S&P 500's at a record high, but we are living in the midst of a classic credit crunch.
Well, can the Fed rate cut ultimately, this leads to the crux of the conversation, can the Fed rate cut cycle that we're in right now alleviate some of the stress and the credit crunch that we're talking about here?
I certainly think that it could, but not at the extremely measured, slow pace that's being contemplated at this point between now and the middle of 2025. You didn't see credit card rates move an inch after the Fed lowered the Fed funds rate by 50 basis points. You're going to see banks continue to be reluctant to lower borrowing costs when it comes to their credit card books until they have cycled through charge-offs. And we're not there yet. So it's kind of a parallel to what happened in China with China lowering the overnight funds rate. If companies are not willing to actually ask to borrow, it really doesn't matter what the cost of money is. And if the Fed is lowering interest rates, but those lower interest rates are only going to apply to the most pristine corporate credits, then it's not going to end up trickling down to the individuals who are really being impaired in terms of their spending by prohibitively high interest expense in things like purchasing an auto and purchasing a home. The best thing that can be said in a move forward basis is that we have a repeat of 2017 when a major hurricane hit the United States, and there was a large replenishment cycle for car buyers because their cars had been flooded. So those are the types of rebuilding efforts that we can look to in the very short term from the disasters of these two large hurricanes. But again, that's a replacement cycle. That's a replacement cycle that can prolong a business cycle, but it's not indicative of a healthy private sector.
Well, Wall Street is mixed on where the economy is headed by Q1 2025. On the one hand, I played for you Jamie Dimon's interview with Bloomberg. In the same interview, he said that don't count on a soft landing next year. He's bearish on the economy. In fact, JP Morgan overall has been more bearish over the last couple of months. Goldman Sachs just updated their end of year S&P target to 6,300 points, saying that the jumbo rate cuts have now put the economy on track for a soft landing. So just mixed messages from Wall Street, big banks, different messages. Where do you stand?
Big banks, different bank books. And when I say book, I mean talking their books. So I would certainly go with Jamie Dimon's opinion before most other banks because he interfaces with so many U.S. consumers. And he is one of the largest lenders on the planet to different sizes of U.S. companies as well as U.S. households. So I think it's fair for him to say, given, again, how many Americans are running dry on their unemployment benefits, how many gig workers there are out there, I think it's a fair assessment for him to say that a soft landing is not in the cards.
What do you feel about yields then? If you're on the camp of, Jamie Dimon's camp, no soft landing, 10-year yields, I guess, down by next year. Does that make sense?
It makes sense. It certainly makes more sense even for your 2-year yields to be coming down as well, because I think that the Fed being strong-armed into going more slowly with rate cuts is going to leave Fed policymakers in a situation next year where they're having to try and play catch up and getting things like, another beige book that shows that spending is impaired nationwide and that the consumer is not actually getting better, that there might even be an effect of many millions of households being reported to the TransUnions and the Experians of the world because they haven't paid their student loans since since March of 2020. So that's something else that's going to begin to be felt among higher income earners in the United States as their credit becomes increasingly impaired because they don't necessarily qualify for student loan forgiveness, which happens to be right now in a holding pattern given the courts.
Let's take a look at your equities outlook then. So if we're expecting yields to fall, Danielle, this is my screen here. The 10-year yield is the bar chart, the S&P 500. The SPX is the purple line here. Over the course of the last 1 year, they've been moving in different directions at different times, but for the most part, ever since the beginning of the year, they've, there's no clear relationship is what I'm trying to say. What do you think of this relationship going forward? Usually, theoretically, in Econ 101, yields up means stocks up, right? Is that going to be true in 2025, you think?
It remains to be seen. If we go back to the discussion that we were just having about Jamie Dimon and the fact that he does not anticipate seeing a soft landing, what we can definitively say is if he's right, then the Fed funds rate's going to come down, the 2-year yield's going to come down, the 10-year yield's going to come down if it's not a soft landing as well. And more importantly, the stock market has more than priced in, fully more than priced in a soft landing.
Any surprises in the data that the markets would take into account if, let's say, the markets are wrong about a soft landing? What would we need to see in the data to have the markets turn around from this upward momentum here?
Well, I think the continuation of, if we can call September something of an aberration when it comes to non-farm payrolls, and Bloomberg economists see the unemployment rate ending 2025 at 4.5% at least. if we go back to the July and August type of payroll reports that we've been seeing, if layoffs continue into the current earnings season as what is anticipated right now, then we will also continue to see a decline in the shelter inflation that really has been the stickiest form of inflation going forward. We had fresh data out of the Census Department that showed that for the second quarter in a row, only about 50% of the apartments that are coming out of the construction pipeline are being rented. And that is, if you've got an oversupply situation like that on your and affordability is not really what it needs to be for new homeowners, then you're going to continue to see a decline in shelter inflation, which is the largest driver overall of both the CPI and the PCE.
Over the last couple of years, there's been a divergence in sentiment amongst the residential and commercial real estate, segueing into real estate now. Commercial real estate, like you said, still in a lot of pain. I've been talking to different analysts about the housing market for the residential side. Again, mixed messages, but for the most part, the housing market has held up steadily despite the Fed funds rate having stayed high up until now. Do you see this divergence in sentiment continuing, which is to say weaker sentiment for the CRE and better sentiment for the housing residential side?
So I think that as a factor of time, you're going to see the impairment, the distress that's in commercial real estate through the conduit of the multifamily sector feed more into residential. And the fact that we really have still a very restrictive monetary policy is making life more and more difficult for the investors who had purchased so much of residential real estate. It certainly cannot help what's happening in Florida with all these natural disasters, in the sense that you're going to have homeownership, homeowners insurance continue to increase. That's going to be spreading into many of the states that were impacted by Hurricane Helene going forward. So the price of owning a home is certainly not going to become, wow, super affordable overnight if the Fed's going to be lowering the Fed funds rate at a slower pace. In fact, mortgage rates today are higher than they were prior to the Fed lowering the Fed funds rate by 50 basis points.
Okay, so bottom line, to sum up, what are the major risks that could derail this momentum and the risk assets that we've seen going forward?
I think the major risk, again, is that a soft landing is more priced into the markets right now.
Asset allocation preferences, have you changed anything since last we spoke? About a month and a half ago. Yeah, 2 months ago.
I will say that there's a certain irony to the fact that money market fund assets increased after
That's right.
lowered interest rates. So, and the other development that we've seen is a steady decline in insider behavior inside in terms of their own stock. Insiders may be projecting to the outside world things are all great and hunky dory inside corporate HQ, but that certainly is not incentivizing them to do anything but sell their own stock.
Well, the other trend as well is the outperformance of certain defensive sectors like consumer staples and the utility sector. So if you want to take a look at my screen here, actually, let me just pull up my screen to illustrate this point. Here is the S&P 500. I'll remove the other line, and I'm going to overlay this with XLU, which is the Spider Utilities ETF. Over the last year, they've moved in tandem. However, if you overlay this using the same percentage scale, you can see that over the last 3 months, the utility sector has been greatly outperforming the S&P 500. I'm just using the utility sector as an example. Why are institutional investors switching to more of a defensive posture ever since the beginning of August, basically?
Well, it's a matter of do as I do, not as I say. If there's one thing that I'll never forget about working on Wall Street during the heat of the dot-com era, it was that investment bankers that were selling the prospectuses of a future dot-com bombs out the front door when they were receiving their personal bonuses in the multi-million-dollar range. It was going into triple tax exempt New York municipal bonds and Berkshire Hathaway stock. So there's something to be said for do as I do, not as I say. And you're looking right now at where the outperformance has been. That tells you that institutions are highly defensive in their posture. That's where the smart money, so to speak, has gone. And again, we are not priced for a soft landing, David. We are priced perfectly for the softest landing of all time.
The softest of all landings, but you basically you disagree with that pricing. Okay, does it make sense though that in a rate cutting cycle, cyclical should do better. But on the other hand, though, when you're looking for yield and yield is going down, a defensive sector like utilities could be a good yield replacement. So how do you reconcile this?
I've actually been telling my clients to be very attuned to the fact that they can still get very nice returns on their cash, but at the same time, that they should be paying the closest attention to which companies do not cut their dividends going forward, regardless of what happens with the financial markets. In other words, companies that have cash flow, companies that have strong top line growth, and companies that can weather any storm. It's not just a matter of one sector, but it's a matter of being much more selective in your posturing by being able to identify the survivors, come what may, in the cyclical economy.
Very good. Tell us more about the research you're doing right now at QI Research and where we can find your work.
So please come to DiMartinoBooth.substack.com. We publish the Daily Feather every trading day of the year, and we enjoy getting into the weeds. We like to look at things like the bankruptcy cycle, the ins and outs of the payroll report, the University of Michigan, what that's telling us about consumer sentiment on an ongoing forward basis, and how that all works into the outlook for monetary policy. Follow me on Twitter if you don't, at DiMartino Booth, and reach out to me if you're interested in becoming an institutional investor. We've got a good community of QI Pro investors who've done fairly well, given my view on the yield curve in recent years.
Okay, well, let's put the links down below, so make sure to follow Danielle there. Thank you very much for your update as always. Looking forward to next time. Take care.
Likewise, you too.
Thank you for watching. Don't forget to like and subscribe.